The collapse of the Bardi and Peruzzi banks in Florence in the 1340s wasn't just the failure of two financial institutions, it was a systemic crisis that destroyed the most sophisticated banking system Europe had yet developed, wiped out the savings of thousands, bankrupted Florence's greatest merchant families, triggered cascading failures across the European economy, and fundamentally changed how people thought about money, banking, and trust. And the cause was a medieval bank run. Except it wasn't depositors panicking and demanding their money back. It was a sovereign default. King Edward III of England refusing to repay the enormous loans that the Bardi and Peruzzi had extended to finance his wars with France. Loans so large relative to the bank's capital that when Edward defaulted, both institutions immediately became insolvent, and the default triggered exactly the dynamic we see in modern bank runs. Creditors and depositors rushed to withdraw their funds. The banks couldn't meet the demands because their assets were illiquid, tied up in loans to Edward and other borrowers. They were forced to liquidate at fire sale prices, selling assets for fractions of their value. And still they couldn't raise enough cash to satisfy withdrawals. And within months both banks collapsed, their branches across Europe closed, their creditors unpaid, their depositors' money gone. And the ripple effects spread across the European economy for years, disrupting trade, destroying credit, impoverishing cities that had relied on these banks for financing, and teaching a generation of bankers and merchants that lending to kings was suicidally dangerous, that sovereign borrowers could default with impunity, and that banking based on trust and reputation without adequate reserves or legal protections was inherently fragile, vulnerable to runs that could destroy even the largest and most prestigious institutions overnight. And these lessons would reshape European banking, leading to more conservative practices, higher reserve ratios, more diversified lending, and eventually to the development of deposit insurance and central banking and the regulatory infrastructure that makes modern banking at least somewhat more stable than medieval banking, though as 2008 proved, not stable enough to prevent crises that echo the Bardi and Peruzzi collapse. The Bardi and Peruzzi were the largest banks in Europe in the early 14th century. They had branches across Italy, France, England, the Low Countries. They handled papal finances, managed the accounts of kings and nobles, financed international trade, dealt in currency exchange, and they were enormously wealthy and powerful. The Bardi family's palace in Florence was among the grandest in the city. Their political influence was substantial. They were part of the ruling oligarchy that controlled Florence. And the same was true of the Peruzzi. And their banking operations were sophisticated. They used bills of exchange to transfer funds across Europe without physically moving gold or silver. They provided credit to merchants for trade ventures. They accepted deposits and paid interest. They invested in commodities and real estate. They were doing everything modern banks do. And they were doing it on a scale that seemed to make them invincible. In 1339, the Bardi had assets of roughly 875,000 gold florins, an enormous sum equivalent to perhaps $1 billion modern dollars. The Peruzzi were similarly large, and together they dominated European finance. There was no institution that could rival them, no government or church or trading company with their capital or reach, and this dominance created the illusion of safety. If the Bardi and Peruzzi could fail, anything could fail, and this possibility seemed remote to contemporaries. These banks had operated successfully for generations, had survived wars and plagues and political upheavals, had weathered previous crises, and their size and prestige suggested they were too big to fail, but of course that proved wrong. The relationship with Edward III developed gradually and disastrously. Edward became King of England in 1327 and almost immediately began planning war with France, claiming the French throne through his mother, beginning what would become the 100 Years' War. And wars are expensive. Medieval armies had to be paid in cash. Soldiers were mercenaries or feudal levies who expected compensation. Equipment and supplies had to be purchased, allies had to be bribed, and Edward's revenues from England weren't sufficient. He needed to borrow, and the Bardi and Peruzzi were willing to lend, partly because lending to kings was prestigious, enhanced the bank's reputation and political connections, partly because Edward offered high interest rates and valuable collateral in the form of future tax revenues and rights to English wool exports. Wool was England's primary export, extremely valuable, and the banks thought they could recover their loans through wool sales even if Edward didn't repay directly, and partly because the banks were competing with each other and with other lenders. If the Bardi didn't lend, the Peruzzi would, or the Frescobaldi or other banks, and the prestige and potential profits were worth the risk, or so they calculated. But the amounts escalated. Edward borrowed more and more to finance larger armies and more ambitious campaigns, and the Bardi and Peruzzi kept lending, partly because they'd already lent so much that they needed Edward to succeed so he could repay them. This is the sunk cost fallacy, but it's also rational from their perspective. If they stopped lending, Edward might lose the war and definitely wouldn't be able to repay existing debts. But if they kept lending, he might win and repay everything. So they were trapped in escalating commitment. The amounts were staggering relative to the bank's capital. By 1342, Edward owed the Bardi approximately 900,000 florins and the Peruzzi 600,000 florins. These sums exceeded the bank's total capital. The Bardi had lent more to Edward than they owned in total assets, and they'd done this by using depositors' money, by borrowing from other creditors, by leveraging their capital many times over. This is what banks do. They lend out more than they have, relying on the assumption that not all depositors will withdraw simultaneously, but it makes them vulnerable. If the loans go bad, if a major borrower defaults, the bank becomes insolvent, can't repay depositors even if it liquidates all its assets. And that's exactly what happened when Edward defaulted. And Edward's default wasn't a surprise. He'd been missing payments for years, had been renegotiating terms, extending deadlines, paying interest but not principal. The banks knew he was in trouble, but they kept hoping he'd recover, kept extending more credit to help him through temporary difficulties. And then in 1342, Edward simply repudiated the debts, declared he wouldn't pay, and there was nothing the banks could do. They had no way to compel a king to pay, couldn't seize his assets or garnish his revenues, couldn't take him to court. Sovereign debt was unenforceable, depended entirely on the sovereign's willingness and ability to pay. And Edward was neither willing nor able. His war was going badly, his revenues were exhausted, and he chose to default rather than bankrupt England trying to repay Italian bankers. The immediate effect was insolvency. The Bardi and Peruzzi couldn't absorb losses of this magnitude. Their capital was wiped out. They owed more than they owned. And when this became known, as it quickly did because in the small world of medieval finance information traveled fast, creditors and depositors panicked. Everyone who had money with these banks tried to withdraw it. Merchants who had deposits, nobles who had accounts, other banks that had correspondent relationships, traders who held bills of exchange issued by the Bardi and Peruzzi. All of them tried to get their money out, and the banks couldn't pay. They didn't have the cash. Their assets were tied up in loans and inventories and real estate. They couldn't liquidate quickly enough to meet the withdrawals. And even when they did sell assets, they got terrible prices because everyone knew they were desperate. So the classic bank run dynamics took over. The faster they tried to liquidate, the worse the prices got, the more they fell short of meeting withdrawals, the more panic spread. And within months, both institutions were bankrupt, their branches closed, their operations ceased. They stopped honoring bills of exchange, stopped accepting deposits, stopped making payments, and thousands of people lost everything they deposited, lost their savings, lost their working capital, lost the money they needed to operate their businesses. And because these banks were so central to the European financial system, their failure disrupted everything. Trade credit dried up, merchants couldn't get financing, commercial activity declined, and the economic effects spread across Europe. The political effects in Florence were dramatic. The Bardi and Peruzzi families had been among the ruling oligarchy, but their bankruptcies destroyed their political power. They were blamed for the crisis, for making reckless loans, for losing their depositors' money, and they lost their positions in government, were excluded from power, and the broader merchant class that had dominated Florence also lost influence. The bankruptcies had destroyed so much wealth, had impoverished so many merchant families, that the balance of power shifted. The guilds representing artisans and small tradesmen gained more influence, and there was popular anger at the banking families, at their recklessness and greed, and this contributed to political instability in Florence for decades, including revolts and regime changes. The social contract between rulers and ruled had been broken. The ruling families had failed in their basic duty to manage the economy competently and trust an elite. Institutions declined. This is what financial crises do. They destroy not just wealth, but legitimacy. They reveal that the people in charge don't actually know what they're doing, that the system isn't as stable or well-managed as it appeared, and this destroys confidence in ways that persist long after the immediate crisis passes. The lessons learned by surviving bankers were conservative. Lending to sovereigns became taboo. Italian banks that survived or emerged after the crisis were much more cautious about royal loans. They diversified their lending more carefully, kept higher reserve ratios, were more selective about clients, and the entire banking model shifted. The Medici Bank that emerged a century later was structured very differently from the Bardi and Peruzzi. It was more decentralized, with branches operating as semi-independent partnerships, so that if one branch failed, it wouldn't bring down the whole system. It avoided sovereign lending almost entirely, focused on safer commercial loans and currency exchange and commodity trading. It maintained much higher capital ratios, and it was more conservative about leverage. And these lessons, learned from the Bardi and Peruzzi collapse, helped the Medici Bank survive and prosper where earlier banks had failed, but they also meant that credit was less available, that interest rates were higher, that economic growth was constrained by more conservative banking. So there was a trade-off: more stability, but less growth, fewer spectacular failures, but also fewer opportunities for expansion and investment. The broader impact on European monetary systems was subtle but profound. The crisis demonstrated that private banks couldn't be trusted to maintain the money supply. When the Bardi and Peruzzi failed, the bills of exchange they'd issued became worthless, and these bills had been circulating as money, used to make payments. And suddenly a large portion of the money supply disappeared. This caused deflation, made debts harder to service, disrupted trade, and it suggested that money creation needed to be controlled by more stable institutions, not private banks subject to bank runs and bankruptcies. And this contributed to the gradual shift toward government-issued money, towards sovereign currencies backed by the state rather than by private institutions. The process took centuries. Modern central banking didn't emerge until the 17th and 18th centuries. But the seeds were planted by crises like the Bardi and Peruzzi collapse, which demonstrated the instability of purely private money creation and the need for some kind of public backing or insurance to prevent money from disappearing when private institutions failed. The comparison to modern bank runs is striking. The basic dynamics are identical. A bank makes loans that are illiquid, long-term, hard to sell quickly, but it finances these loans with deposits that are liquid, short-term, can be withdrawn on demand. This maturity mismatch is inherent to banking. It's how banks work, transforming short-term deposits into long-term loans, but it creates vulnerability. If depositors lose confidence and withdraw simultaneously, the bank can't meet the withdrawals. Even if it's fundamentally solvent, even if its assets exceed its liabilities, because it can't turn those assets into cash quickly enough, and the attempt to liquidate quickly destroys value, forces asset sales at depressed prices, turns liquidity crisis into solvency crisis. And this is exactly what happened to the Bardi and Peruzzi, and it's exactly what happened to Northern Rock in 2007, to Lehman Brothers in 2008, to Silicon Valley Bank in 2023. The technology changes, the specific triggers differ, but the underlying mechanism is the same. Banks are inherently fragile because of maturity transformation, and preventing runs requires either preventing panic through deposit insurance and central bank backstops, or preventing the conditions that cause panic through regulation and supervision, or accepting that periodic crises are inevitable and having mechanisms to manage them without destroying the entire financial system. The medieval response to bank failures was primitive. There was no central bank to provide liquidity, no deposit insurance to protect depositors, no bankruptcy code to manage orderly resolution. When banks failed, they just failed, doors closed, depositors lost everything. And the process was chaotic. Creditors fought over the remnants. Courts tried to sort out conflicting claims, but the process took years and recovered only pennies on the dollar. And in the meantime, the economic damage was enormous. Credit markets froze, commerce declined, unemployment increased, and these effects persisted until confidence was gradually restored, which could take a generation. So the social cost of allowing bank failures was immense. and gradually societies learned to create institutions to prevent or manage failures. Deposit insurance, so depositors wouldn't panic. Central banks that could lend to solvent but illiquid banks. Bankruptcy procedures that could resolve failures in orderly ways. Capital requirements and supervision to reduce the probability of failure. All of these emerged over centuries, partly in response to repeated crises that demonstrated the costs of not having these institutions. And the Bardi and Peruzzi collapse was an important early demonstration, showing that bank failures could cause systemic crises affecting the entire economy, and that preventing such failures might be worth the cost of creating public institutions and regulations. The question of whether the Bardi and Peruzzi were victims of bad luck or architects of their own destruction is complex. On one hand, they were victims. Edward's default was beyond their control. They couldn't have compelled him to pay, and sovereign default was an inherent risk of lending to kings. But on the other hand, they made choices that magnified this risk. They lent far too much to one borrower, concentrating their portfolio dangerously. They lent more than their capital, becoming insolvent if the loans went bad. They used depositors' money to make risky loans without adequately informing depositors of the risks. They kept extending more credit to Edward even when it was clear he was in trouble, hoping to save their existing loans through good money after bad. So they weren't innocents. They were making calculated bets that went wrong, but calculated bets that in retrospect were obviously reckless. The question is whether it was obvious at the time, whether contemporary bankers should have recognized the risks, or whether this is just hindsight bias. And probably the answer is both. Some contemporaries warned against sovereign lending, recognized the risks, but the Bardi and Peruzzi chose to ignore those warnings because the potential profits and prestige were so attractive. They thought they were smart enough to manage the risks, and they were wrong, and thousands of people paid the price for their mistakes. The legacy of the Bardi and Peruzzi collapse extends to our own time. When Silicon Valley Bank failed in 2023, when depositors rushed to withdraw, when the bank couldn't meet withdrawals and had to be seized by regulators, the dynamics were the same as in 1340s Florence. A bank had made long-term investments, in this case bonds, that lost value when interest rates rose, and it funded those investments with deposits that could be withdrawn on demand. And when depositors lost confidence and withdrew, the bank failed, and the government had to step in to protect depositors and prevent contagion, just as medieval governments tried to do after the Bardi and Peruzzi collapse, though with better tools and more success. But the fundamental fragility remains. Banks can still fail, runs can still happen, and the public sector still has to intervene to prevent systemic collapse. We've gotten better at managing bank failures, at preventing them from destroying the entire financial system. But we haven't eliminated the underlying vulnerability, and perhaps we can't. Perhaps maturity, transformation, and the resulting fragility are inherent to banking, and the best we can do is manage the risks and limit the damage when failures occur, rather than preventing failures entirely. And this acceptance that crises are inevitable, that the best we can do is make them less frequent and less damaging. This is the wisdom that emerges from 7 centuries of bank failures, starting with the Bardi and Peruzzi. The medieval bank run that changed money forever changed it by demonstrating that private money creation was inherently unstable, that banks left to themselves would take excessive risks and periodically fail catastrophically, and that some kind of public intervention or regulation was necessary to maintain financial stability. And this lesson has been repeatedly forgotten and relearned. Every generation of bankers believes they're smarter than their predecessors, that they've found ways to eliminate risk, that this time is different, and every generation discovers through painful experience that banking is still fragile, that runs can still happen, that even the largest and most prestigious institutions can fail, and that the consequences affect not just the bankers, but everyone who depends on the financial system functioning, which in a modern economy is everyone. So the Bardi and Peruzzi collapse in 1340s Florence, despite being separated from us by 7 centuries and occurring in a very different economic and technological context, remains relevant, remains instructive, remains a warning about the dangers of excessive leverage and concentrated lending and overconfidence in private institutions' ability to manage systemic risks. The medieval bankers who built the Bardi and Peruzzi into the greatest financial institutions of their age thought they understood risk, thought they could manage it, thought they were too big and too sophisticated to fail, and they were wrong. And their failure taught lessons that we're still learning, still forgetting, and still relearning through painful experience. Because apparently some lessons can only be taught through catastrophe, can only be learned through actual failure, and have to be relearned by each generation, making the medieval bank run that destroyed the Bardi and Peruzzi not a unique historical event, but the first in a series that continues to our own time. Each iteration similar in its basic dynamics, but specific in its details. Each teaching and reteaching the same fundamental lessons about banking and trust and systemic fragility. Lessons that changed money forever by demonstrating that financial stability requires more than just private institutions operating in competitive markets. Requires public institutions and regulations and safety nets. Requires accepting that banks are special, are systemically important, and need to be supervised and supported in ways that other businesses aren't. These insights, purchased at terrible cost in 1340s Florence and repurchased at terrible cost repeatedly since then, are the legacy of the medieval bank run that changed money forever.